Hi, Grant, and thank you for joining us today.
Yeah, hi, Jimmy. It's a pleasure to be here. Thank you.
Grant, I want to provide a framework on where I want to take our discussion, and I want to begin with a macro view, a top-down look at the spot and the term markets, followed by a discussion on Cameco and your various operations. And before we get into that, the Nuclear Energy Institute recently held a conference in Savannah, Georgia, and it's one of the main conferences for the nuclear industry. And you had the opportunity to attend. And one of the great things about going to a conference is that you meet people face to face and you can gather a lot of information. And I'm just kind of curious what people were saying at the conference. Were people talking about what's happening in the spot market and the term market?
Yeah, certainly it was a conference. First time we had all been together in almost 2 years, face to face. This conference generally attracts US utilities. It's not the global conference, but that's a pretty important customer group. So it really does set the tone. And one of the great observations for us is that the tone has improved. We've gone through a lot of really rough highway in the front end of the nuclear industry. Prices terribly low. You've seen a lot of folks struggling to get by in that market. But now we're seeing a strengthening tone. It seems to be recognized both on the supply side and the demand side. I would say our customers largely understand the days of buying uranium that starts with a 2 are probably over. The days of buying uranium that starts with a 3 are probably over. And I think the question is, how much can they buy that starts with a 4 before they have to pay even more for it? And that's because that's where the fundamentals are. We're a funny industry right now. There's very little debate that the demand picture is strengthening, and it's strengthening in a durable way that we haven't seen for quite some time. And yet productive capacity, if you extrapolate it forward, is not keeping up. And so we're now sort of catching that fundamental reality, and that's what's being reflected in price strengthening.
And Grant, nuclear power provides approximately 20% of electricity generation in the US. And because it's only 20%, do US utilities care about the recent move in the uranium price, or are they more concerned with the move in nat gas and coal?
Well, I mean, I think it would be inaccurate to say they don't care about their costs and whether those costs are a big driver of their operating and maintenance budget or a small. Like everybody else, every penny counts. But the reality in our business is that our customers have been price sensitive largely because the supply side has let them be. The typical reactor is focused on security of supply. Utilities don't buy in the spot market for their run rate requirements. They buy that in the term market, and they cover it for many years at a time. The only reason that they've been price sensitive is because we've seen some stubborn production that had no home because it was improperly timed for a market cycle, show up with no place to go, no term demand post Fukushima, and it got dumped into the spot market. And that's really what afforded the fuel buyers the opportunity to be price sensitive. But in a normal world, it's more important that the fuel bundle is there to power the reactor, because if you brought a reactor down because you were quarreling over pennies and dimes, maybe quarters on the price of uranium, that's a significant career limiting move for our customers. And so, hopefully we've entered a situation now where the supply side has collectively understood that making material available in the spot market is no way to create value. And there are utilities that are willing to pay production economics for uranium if we just let them.
So that's a great overview of the conference. Thank you. And let's move on and touch on the spot market and what's been happening there. You just talked about uncommitted primary production and how that's distorting the spot market. Can you give us your views on what's been happening in the spot market in the last few months?
Yeah, and if it's okay, Jimmy, I might actually stretch it back a little bit longer, because I think understanding where we've been is pretty important to understand where we're going. Right now, there's a lot of focus on the spot market, new investors to the space. There's a lot of trade press. There's a lot of broader general press on what's going on in the spot market. And it's a bit of a head scratcher when you think it's not the fundamental market in the uranium space. So why is there so much attention on the spot? Well, that's the problem that needed to be solved. We came out of a nuclear event, and that, of course, was the Fukushima event. And we went into one of those classic divergence moments. Demand was falling away, utilities shutting down reactors, like in Japan, building new regulatory frameworks. A lot of reactor capacity was idled. Countries that were on a path decided to abandon it. Germany would be a good example there. And while demand was reacting downward to Fukushima, a lot of supply that had been incented prior to Fukushima continued with an investment and then ended up as production, and all this shiny new production showed up, and there wasn't a contracting cycle going on. And that's what I talked about earlier, that it ended up in the spot market. So normally the spot market is a small discretionary market. Utilities really only use it to shore up their inventory position, or to buy a reload during a fuel outage, planned well in advance, of course. And that's going to be true whether the world is consuming 180 million pounds of uranium or 300 million pounds of uranium on an annual basis. Utilities will not use that as the fundamental market. But when this productive capacity showed up and it had no home in a term contract, it ended up in the spot. And then our story took a turn. You know, the oversupplied spot broke the price signaling. The term price, which was supposed to reflect production economics, actually became nothing more than the forward price of buying in the spot and carrying it. And utilities said to themselves, hey, as long as suppliers are going to continue to put primary production in the spot market, I'm not going into the term market. I'm just going to find a financial who's willing to buy in spot and carry it forward in a low interest rate environment. And we had the creation of the carry trade. And the carry trade started to rob term demand. And as it robbed term demand, we saw levels of term contracting go down further and further, and we saw the collapse of the term price away from production economics. So the spot market has taken on this outsized role because it needed to be cleaned up. Cameco's entire strategy in the last number of years has been to contribute to the cleanup of the market. We're not an offender. We don't sell our production into the spot market. But sitting around and waiting for others to do the right thing wasn't a good strategy. So what we embarked on was a very aggressive supply discipline strategy. And we took down some of our assets, starting with Rabbit Lake and then our US assets. And that wasn't enough. So then we curtailed McArthur River, and we curtailed it well below our committed sales, our term contract homes, because that was the only way we could have an impact on the spot market. We became the largest buyer in the spot market. And so as the spot market was cleaned up, it then paved the way for what we're seeing now. You know, a smart physical fund manager who knows commodities and has played in the space in other metals realized the opportunity was now. The big heavy lifting had happened, and they could come in and harness investor interest, deploy it specifically in the spot market, prove that it really truly is a thinly traded market. It's had a significant impact on the spot price. And now we're starting to see the fruits of that, with the reflection being in the term price, as utilities are going, okay, the days of buying spot material and carrying it into the term market are probably over. We're in a slightly backwarded market, so the most expensive pounds they're going to buy actually are the carry trade pounds right now. And so the conversations are returning to, what does a term contract need to be? So spot price is up, and now term price is up about $10 on average. This is the direction we needed to see. We needed to take the spot market from being the problem and turn it into part of the solution. And that's what we're seeing with the emergence of the physical funds, and in particular, the Sprott Physical Uranium Trust.
So overall, the spot market has become a lot more efficient because of your actions and also actions of others.
No question. We're seeing a degree of transparency and a degree of liquidity in the spot market that we're not accustomed to in this industry. You know, our industry has a price reporting mechanism, not a price discovery mechanism. We don't have the volume or the frequency to truly discover a price. And price reporting involves a lot of judgment. And a lot of judgment means that there's a lot of opinion in it. And then along comes actors like us buying at the front end of the spot market, like the Sprott vehicle buying at the front end of the spot market, posting actual transactions that you don't have to debate or apply any judgment on what the price really is. There's a degree of transparency and liquidity and now price discovery that we haven't seen before. It's a good thing for the industry.
So that's a great overview of the spot market. Let's move on and discuss the term market. And I'm hoping you can give us some color in how many RFPs are in the market right now, and maybe what countries are involved in the market right now.
Yeah, great question. That is how value truly gets created in the uranium space, by participating in a contracting cycle, by building homes for productive capacity, and then designing your production plans to go into those homes and stay off the spot market. And so it is great to see the term market start to pick up. It had begun to show some life since we started our strategy back in 2016. We've layered on another 60 million pounds of long-term contracts into our book. It's about as much as we want to be doing. We don't want to be doing a whole lot more. This is mostly off-market stuff. It's the type of work we do bilaterally, exclusively with the utilities who've kind of figured it out. They better start contracting. But the other part of the market is the on-market RFPs that you referenced, where utilities come out in a very public fashion, and they pit the producers against each other and try to get very competitive pricing. And normally the interplay has been, for us, a fair amount of off-market discussion with the occasional RFP. But what's interesting this time is we actually might see less on-market RFPs than we normally would, because the leverage of an on-market RFP has kind of gone away. When you're dealing with a utility off-market, and you're pushing for price mechanisms that are levered to future prices, for example, as a producer, our customers were always able to dangle the prospect of an RFP over us and say, oh, well, okay, yeah, you really want a lot of market leverage there. Maybe we should just do an RFP and find out what Kazatomprom is thinking or what Orano is thinking about prices going forward. And that was always a bit of bargaining power for our utilities. But now, with the presence of this Sprott vehicle, I think utilities are rightly weary of putting too much public demand in the market, because that'll go around the investor community really quickly, especially if particular utilities, the bigger ones, get identified as having demand in the market. Bit of a worry that signal might charge the at the market feature for the Sprott vehicle. They'll issue a bunch of trust units, take in proceeds, and then go on one of their demand surges precisely at the time where utilities trying to price their contract going forward. So we actually may see a continuation of more off-market activity, but that's good news, because in our business, contracting begets contracting, and we're in the very early innings of it. There have been a few RFPs, there's been some off-market stuff, but we are a far way away from even replacement rate contracting, which is where utilities are buying basically what they consume every year. Versus the beyond replacement rate contracting that happens when a true security of supply sentiment sets. So we've seen a $10 increase in the term price, and we're only in the very early innings of this transition.
So I'm curious about the mechanics behind these off-market transactions. And just so I understand, will a utility phone you up and say, hey, Grant, I need 10 million pounds, can you help me out? Is that the discussion?
Well, yeah, I mean, we can sort of describe it that way, but remember, we never stop talking to our utility customers, because there's nobody that we're dealing with who isn't already a customer, and we're already selling the material. And so, since Fukushima hit, we've delivered over 300 million pounds of uranium. This is the business we're in, so we're constantly in contact. And it wasn't that our customers were uninterested in where future supply was coming from. It was the gap between the bid and the ask spread on the price was just too big for us to be willing to lock in volumes, because we don't have a volume strategy. And so as the price starts to move, those conversations get firmer and firmer, and they're really about taking the business we already have and build it going forward, as opposed to kind of starting from scratch off market.
And I'm curious about how the terms have changed, in the past year. Are people looking for longer term contracts? Are they going from 3 years to 5 years to 10 years?
Yeah, it's a great question. So I'd said earlier, spot's not the primary market. And when we go through these term contracting cycles, the tenor of the term business stretches out. So if you think about the price spike in 2010 or the price spike back in 2007, the industry kind of ended up with a term contract that was on average 10 years. So some utilities were taking a much bigger bite out of the market. Some were taking a smaller bite, but the average was 10 years. But as we came through the Fukushima situation and the spot was oversupplied, tenors shrunk, right? Because carry trade can't be as long as a term contract with a primary producer who actually has a productive asset. It's as long as a financial is willing to carry that material. So we saw the tenor shrink. Utilities were taking smaller bites out of the market, 2 years, 3 years, 5 years, so that they could still participate in the competition of the carry trade and not throw their demand far enough out so that they actually had to price productive capacity in there. But now, as we start to emerge into more of a sustained term contracting cycle where utilities are looking out into the middle of the decade and beyond, and they're seeing that demand curve go up in a durable way, and they're seeing the productive capacity today only cover about 70% of the demand that's out there. That's when you start to see the contracting develop at a frequency and a volume, and it stretches the tenors back out. And I'd said in our Q3 conference call, in response to a question, I was asked kind of the tenors in our pipeline of off-market discussions. And I said, we've got some utilities that we're talking to right now about material in the next year, 2, 3. But we've got some utilities we're talking to about material to the end of the 2030s. So these are the types of demand signals that really are the leading indicators of a cycle.
Interesting. And you made mention of the price move we saw back in 2010, and that was on the back of the Chinese entering the market and pretty well taking up a lot of the supply, and it drove the price. If I remember correctly, it might have gone from $30 to $70. Does that sound right?
Yes, good memory. Peaked at 74 just before the earthquake and tsunami hit the shores of Japan.
So I guess my question to you is, the Chinese just entered into a couple of contracts with Kazatomprom that was press released. And do you think this is the beginning of a new wave of buying from the Chinese?
Well, I do, but I wouldn't say that I'm prepared to conclude they're going to come in the way they did last time. It was a bold move. It was a big move. They came in the summer of 2010, really for the first time to the term market. The rest of the utility base around the planet was pretty well covered in 2011, 2012, 2013. We were sitting in kind of one of those very complacent windows. Price had come off a long way since 2007's peak, and they bought 150 million pounds in 1 month. A third from us, a third from Kazatomprom, and a third from the French. Big bites out of the market, and effectively they were buying for 2014 to 2024. That's basically what they were doing, a big bite out of the market. And they forced all the other utilities who were well covered for the next several years to actually go through the door at the same time, because the big new entrant was tying up all that material. But I would say that our Chinese customers probably don't want a repeat of that. They probably realized that it was too much at once, and it triggered one of those contracting cycles. And so I think this notion of RFPs, smaller bites out of the market, layering in more frequently, that's probably a behavior that you can expect to see unless we have, a shock-driven reason to see bigger demand. An energy policy failure where other energy sources within country are not performing like they should be, and a doubling down of the nuclear enterprise, and therefore nervousness about the strategic inventory and the run rate requirements. If that kind of shock hit, then you could see a bigger chunk being taken out of the market, more like 2010. But if it were to be done in a more rational way, I think we can just expect them to be a more frequent buyer. They're going to need the market to meet their needs, and probably take smaller bites out of the market and layer them in over time, like largely the rest of the utilities do.
So that's a great overview of both the spot and the term market. Why don't we move on and talk about Cameco now, and just why don't you provide us with a brief overview of Cameco and its various operations?
Yeah, happy to do that. So I'm glad we started with the market, because that explains why we do what we do. And so Cameco today is a company that has just come through probably the worst bear market in the uranium space on a cost-adjusted basis that we've ever seen. We've come through that with $1.4 billion in the bank, an investment grade rating, leveraged to future prices in an extraordinary way. So we're very, very comfortable with the position we're in. But getting to this position was not painless. It required us to take a lot of leadership in the market. That leadership was the form of an extreme supply discipline. Others, we talk about Kazatomprom taking 20% supply discipline, for example. We were at 70%. Cameco alone left 114 million pounds of uranium in the ground. We bought 56 million pounds of uranium. Sprott's at 20 now. We bought 56. We drew down a 20 million pound inventory that we had built up because we were too stubborn to sell material into a weak spot market. And we achieved all of that with a robust balance sheet and now leverage to the upside. So we preserved some of the best assets in the world for future prices and better prices. We feel pretty good about that. We're still in our supply discipline, but happy with what we're seeing in terms of the evolution of a term contracting cycle. So we're sitting here as a tier one producer with tier one assets, plenty of leverage to the upside, plenty of protection if the market stays weak for a bit longer, and really like the position we're in at a time when the world is also saying it's not good enough just to be a producer. You got to be a producer that achieves world-class ESG metrics at the same time. We love that conversation, as you know. ESG, the only thing new about that for us is the moniker. It's been at the very heart of what we do from the beginning. So we just really like the way this is shaping up. Our Canadian supply geared for a market that's worrying about where origins are coming from. It's just, I think really is looking very promising for us.
And one of your key producing mines is Cigar Lake. It produced 5 million pounds last year in 2020. How's it tracking in 2021?
Yeah, thanks for that. Cigar Lake, of course, is been continuing to run. So while we were on supply discipline, it really was the McArthur asset combined with our US and Rabbit Lake assets that were bearing the brunt of that. And we've continued to run Cigar Lake and our asset in Kazakhstan. We've got an extraordinary asset that we own with Kazatomprom, and we're very, very pleased with it. But Cigar Lake running it is part of our strategy. We can't do all of the cleanup ourselves without some tier one costs coming into our structure to help offset the pain of care and maintenance and the pain of buying material more expensive than we can produce it for at McArthur. So Cigar's pretty key to that. But Cigar was not immune to COVID. So we had a shutdown last year, and we also had a shutdown for a period of time this year as we were, awaiting the vaccinations and making sure the industrial protocols were there, not just to keep our workers safe, but to keep their families safe and to keep the community safe. As you know, these are remote operations, and we draw a lot of workforce from the northern communities here in Saskatchewan. And we have just an absolutely inviolable commitment to their health and safety. And these are communities that don't have access to the same level of healthcare that we would have just down the street. So our burden and our responsibility was higher, and we took it very seriously, and that's why we shut Cigar down. When we brought it back up, when all the protocols were in place, very effective restart. It continues to track at annualized rates, which is where we want it to be. But we were never going to catch up with production. We were never going to catch up in year. Didn't intend to. So it's operating very well. It's operating the way we want it to be. And it's a key part of our strategy.
And by having McArthur River and Key Lake offline, how many pounds have you removed from the market?
Yeah, if you think about the whole basket of our production curtailment, that's 114 million pounds of uranium that have stayed in the ground. And so think about it this way. We choose to inventory material in the ground and rather than pull it out of the ground and put it in a shed. And the reason we do that is we think it's just a much more powerful signal. If you don't need it today, then leave it in the ground, because then it's very clear that it's an economic decision to go after it versus a cost of carry or a working capital decision. You know, we discovered as we were producing from McArthur and building up an inventory because we were too stubborn to sell, we were becoming an overhang in the market. You know, we would sit with our customers and we would say, we're looking at your uncovered requirements, you know, and we think you need to start signing contracts. And they'd say, well, we're looking at your inventory and we think you need to start selling material. So we said, okay, we can deal with this problem ourselves. We can curtail. We can run that inventory through our committed sales portfolio, never see those pounds again. And so for us, that discipline has been the inventory is there, it's still in the ground. And here's one way to think about our strategy. When we embarked on McArthur's shutdown, the uranium price was under $20 per pound. It was actually at its low of $17.75 per pound for a brief period of time, and probably going lower had extreme action not been taken. Today, in the spot market, it's at 47. So on a mark-to-market basis, those pounds we left in the ground, that's a $3 billion value transfer. That seems like a pretty good payback on our strategy in a short period of time.
You mentioned earlier that your balance sheet is in very good shape. You're sitting on $1.4 billion in cash. How are you going to allocate that in the coming year?
Yeah, for us, the decisions around our capital allocation are really about shoring up that run rate business. So I said we're in the early innings of a term contracting recovery, but that also means we're not there yet. We haven't made the decision to restart McArthur. So while McArthur is down, while we have to source material outside of producing it in order to meet our committed sales, we've taken the position that we're going to self-manage risk. We're going to be very conservative with our balance sheet, and we're going to send the signal very loud and clear to our owners that they can count on us not coming along with any awkward lurches to the capital markets because we have to say, well, we embarked on a strategy we couldn't afford, or we embarked on a strategy we couldn't manage ourselves. So for us, this has been a key part of managing through this cycle and sticking to this strategy to see the payoff that is starting to emerge as that book of business builds. And as we're in a position to restart McArthur, we restore our tier one costs. We shed the care and maintenance costs. We get out from under buying material way more expensive than we can produce it for. It restores our financial performance in a fairly dramatic way, as you can imagine. These are tier one assets, and we're eager to get them running at the right time. And at that point, it'll trigger a conversation, the obvious conversation. Are we sitting on a cash position that should be deployed for something else? Do I have a great investment proposition to take to the owners? I'm not sure at the moment. At the moment, we've got a brownfield leverage strategy that can be funded out of cash flow. So it's not clear to me we would need it for that reason. So we go through the exercise of saying, well, what's the best purpose for it then? And if we don't need it, then we stick to the principle that we're not the savings account of our owners, and we're going to give it back. And then it's a matter of figuring out the best way to allocate it back to the owners who deserve it for the patients. So for us, We're not out of the woods yet. We're still on our extreme supply discipline, but we're in a very comfortable position being able to self-manage risk.
Grant, as we wrap up, what can investors in Cameco expect in terms of news flow in the coming months?
Yeah, we're going to continue to talk about the contracts that we're able to secure. So we'll talk about our pipeline. We'll talk about what we're seeing. Obviously, as we start to build back to a situation where we can do what we do best, which is mine, you'll hear that from us. But we recognize that it can be an opaque market. So we'll take opportunities like this one, Jimmy, to just at least share how the world looks through our eyes. Where not everybody agrees with us tactically on what we do, and we get that. We're in this full cycle. We've seen every single cycle. We've survived every single cycle, both the ups and the downs. But we'll always share what the world looks like through our eyes. So probably hear more from us if you invite us back. We'll take up that invitation, because I think it's important to help people understand how this market actually works, because there's a great investment opportunity that still remains ahead.
Grant, I have one more question before I let you go. I'm going to put you on the spot now. Where's the price of uranium going to be in 5 years?
Yeah, well, it's a great question that I won't answer and I can't answer, but maybe from a framework point of view. What we know is that in order for productive capacity to match demand, we need prices that incent production, and that incent production from the tier one assets that aren't producing at full capacity or are at zero. So we need that price move. Not quite there yet, but we also need a price move that is going to incent tier two assets that are licensed, permitted, but not running to come back to the market. We also need a price that's going to incent the beginnings of investment in new production. And I don't quarrel with the folks who put out the big cost studies that say that price probably starts with a 6 or probably starts with a 7. That's where it needs to be to truly incent the production. And then, of course, it's up to the supply side to do it right. It's up to the commercial players. You can only have limited expectations on the state-owned enterprises, but the commercial side of the business has to do it right. They have to have a great resource that they align with the opportunity in the market. Because if they have a great resource that's not aligned with the opportunity in the market, we're just going to go through one of these cycles again. We're going to end up investing in a bunch of productive capacity that's homeless, and it's going to end up in the spot market. We're going to resume the carry trade, and then we're going to have to fix the market all over again. So hopefully, lessons learned. Lessons learned, take great assets, time them with the market. Prices probably need to be starting with a 6 or 7 to see that kind of sustained investment that's going to meet what is truly becoming a robust demand profile for this exciting industry.
Well, great. That was a great discussion, and thank you for sharing your thoughts on both the spot market and the term market, and also Cameco's various operations. And to all of our viewers, if you have any further questions for Grant and his team, by all means, send us an email to info@bloorstreetcapital.com and we'll get you an answer. Grant, once again, thank you.
Yeah, thank you, Jimmy. It's our pleasure.